Summer in the city, back of my neck getting dirt and gritty.
Welcome back, everybody. North American energy producer Enerplus spiking on news that it's increasing production guidance and CapEx spending for 2015. Meantime, oil prices settling at the highest level for the year after 6 straight weekly supply drops. Joining us right now with more on this news and where oil prices are headed is Ian Dundas. He is the Enerplus president and CEO. And Ian, thanks so much for being here today.
Appreciate the opportunity.
So you are zigging while everybody else is zagging. Why are you increasing production, and why are you kind of doubling down at this point?
Oh, I don't think we're doubling down. We put a press release out yesterday that had two points in it. First and foremost, we just announced strong operating results, that we'd come into this year performing well operationally, and that operational momentum continued to the first half of the year. And so, production was strong and at the high end of guidance, and that's always a positive story for investors. As you mentioned, though, we also modestly increased our capital, and I think that drives strong production growth, but more importantly, strong funds flow growth, and helps our financial metrics. And so I think that was a positive thing in the context of our business.
But my point is that all of the majors, ExxonMobil, just about every one of the major oil companies that we looked at has talked about cutting capital expenditures and also said that they will be cutting production for this year. Why are you looking at this differently?
Yeah, well, let's go back to the beginning of this year. Our company, like many others, reacted quite quickly to this crisis that the industry has found itself in. With falling prices, and we were absolutely convinced that our primary goal was to maintain our financial strength. And we came into this market moment in a very good position, strong financially. We had a good hedge book, a good portfolio. And again, our primary goal was to maintain that financial strength and ensure that our focus was on shareholder returns. So in connection with that, we cut capital exceptionally aggressively. We high-graded our program. We even went so far as to defer the completion activities on programs where we had already sunk a portion of the capital. It made no sense to us at that moment to complete these high-rate wells, largely in North Dakota, oil wells in North Dakota. It made no sense to complete these wells where we really hadn't seen cost improvement yet. Oil was falling and a tremendous amount of uncertainty. So if now, fast forward to this moment, we have seen costs come down. In the first quarter, cost improvement was a solid 15% across the board. We see that improving.
That's in terms of how much it costs you to go ahead and drill a well.
Yeah, well, across the board, our total cost structures, we see largely on drilling costs and the completion costs, but our G&A costs and our operating costs, if you look at that whole picture, you've seen some significant cost improvement, and that's continuing. So cost improvement, so now we have better economics that we're dealing with. We've also seen the price of oil come up a bit. But more importantly, we now have an ability to hedge some of that. So we've got a position now where we've got this highly economic activity. We've got a strong balance sheet. We can afford it, which is part of the equation. Again, we came into this with a really modest amount of debt. So that incremental spending is driving some good metrics for us. I don't think we're doubling down, and we're not making this bold call on oil. We just have an ability to hedge really powerful economic returns in this market.
So is it more fair to say that this increase in capital expenditures really is just less of a cut than you had originally anticipated? It now looks like you're going to be spending an additional $60 million, which gets you to $540 million. How does that compare with your initial plans for capital expenditures?
Again, I don't want to come back here, but the history is important. As we came into the end of last year and oil prices just kept falling like a knife, we cut very aggressively. And at that point, our idea was not to drill and not complete wells. Then oil fell again, and we cut again. So I guess we're just bringing back a little bit of that additional capital. It's still a significant cut. This $540 million we're talking about is significantly less than we would have spent last year.
Okay, that clarifies the situation. But you are looking at WTI now trading around $60. Do you think that's the new floor for oil prices, or could we be looking at south of $50 again?
It is a confusing time in the oil market for sure. You've got some really strong competing forces. We're seeing really bullish signs in terms of demand for oil. You see it on the natural gas side as well. You've got a lot of geopolitical uncertainty out there. You've got producers cutting capital really aggressively. Then there is this inventory of uncompleted wells in North Dakota that could bring some low-hanging fruit in the market. I think from our perspective, this is just going to be a situation of continued volatility. It's really not our call. It's not our job to make that call. It's not how we think about our job. It's to manage risk and allocate capital really clearly. I would say it's difficult for us to imagine a sustained $50 world without significant additional improvement on the cost side.
I know that it's not your job to try and figure out where oil prices are. Nobody can really anticipate what's going to happen with that. However, I do know that your expected rate of return for these completions of wells, when you exclude the money that's already been put in for drilling early on, is about 60% when WTI is at $60. What happens if it goes to $70, $80? What happens if it falls back to 50 and below?
Yeah, so these uncompleted wells are somewhat confusing to people because there is some of this sunk capital, and so we're talking about these not full cycle economics. This 60% rate of return, obviously it's more robust if prices are higher, and it's pretty strong right now. The break-even supply cost on this kind of spending is in the low 40s. The way that we are dealing with that price uncertainty that exists is a hedging program for us. So we've increased our hedging program in connection with this spending activity. We've added hedges in the back half of the year and into next year as well. Structures that we're using now, give us some floor protection, sort of in that $60 range, and we can participate to a point if prices rise.
But you would say, Ian, that it's fair to say that the moves that you've just announced show a little bit more confidence in the market than we had, let's say, just 4 or 5 months ago.
I think that's fair. I think it shows confidence. I think you got to put it in the context of our company, though, which is we have a very strong balance sheet, and so we had financial choices available to us.
Sure.
This decision to defer completions was we saw economics at the time. We saw economic returns that were, I guess, modest at the time. It just didn't make any sense to us to do it, and we thought it was a better idea to make money. So is there more? Is this a broad phenomena? I think there are other producers in this situation. Our position in North Dakota is clearly in the top quartile of the play, so that helps our economic returns markedly compared to others. But I think there are some signs out there that are somewhat more bullish, and I think we're dealing with a little bit less uncertainty than we were dealing with at the front end of the year.
Okay. Ian, thank you so much for joining us today. We really appreciate your time.
Yeah, I appreciate your time too. Thank you.